It is no time to be an academic. It is time to get on the Bear Stearns call. Listen, open the darn Fed window. He has no idea how bad it is out there. He has no idea. He has no idea.
Kramer.
I have talked to the heads of almost every single one of these firms in the last 72 hours, and he has no idea what it's like out there. None! And Bill Poole has no idea what it's like out there. My people have been in this game for 25 years, and they are losing their jobs, and these firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
Kramer.
Coming up today, stocks finish sharply lower, with fear spreading throughout the world. Did Jay Powell make a mistake? Jobs report comes in weaker than expected. Are we on the verge of a recession? Treasury yields plummet, along with Amazon. Should we buy the dip? A look at commodities, and the West gets ready to respond to Iran. It's going to be a big one, guys. Let's go. Welcome back, everybody, and doesn't the market do a great job at keeping it interesting for us all? And what a finish to a very volatile week. You can see plenty of red across the market color, volatility, gold, and defensive sectors green across the board. S&P 500 oscillator now moving into oversold territory, and we're currently in the biggest pullback of the year, having done a 6.5% retracement from all-time highs. That's now bigger than what we saw back in April, and in fact the Nasdaq Qs has done over a 10% retracement, what they technically call a correction. If it falls more than 20%, that's said to be a bear market. And that huge rotation into small caps having a significant pullback as well. Russell 2000 down 3.5% today. Another massive spike in the VIX. Average is going down to a 15-minute chart. Almost got up to 30 right out of the gate as soon as regular trading started. But by mid-morning, it had started to roll over and still finishing pretty high there at 23.3. That's the highest reading we've got all year. And just going out to a weekly chart on the VIX. We haven't seen these levels since March of last year. Bit of a bump up in the volatility of other markets as well. Gold, oil spiking up, and getting a bit of a bump up in bond market volatility. But out of all the moves we got today, what was definitely the most impressive was that in US government bond yields. Look at the 2-year. Absolutely nosediving, starting to look like capitulation here. 3.88%. Huge gap between that and the Fed funds rate. Another big move in the 10-year as well, sitting right at the bottom of this support zone. I drew in yesterday, 379. And like I'd been saying, long-dated treasury bonds had been looking good coming into this week, especially so going out to the weekly chart. Another fat green candle on volume, really strong signs of accumulation, and we may have just seen the end of the historic bear market in treasury bonds. And we are getting a bit of unwinding of risk today. You can see that in high yield bonds, and can especially see that in the spread of high beta stocks versus low volatility stocks. Coming off more than 4% today, just like it did yesterday, been a sharp reversal in the last couple of weeks. And so there's a few things going on here. Why all of this is happening, and we really shouldn't be surprised. We did have some weak economic data yesterday with manufacturing, rising jobless claims. Of course, the big one today, the jobs report, non-farm payrolls. US economy adding less jobs than expected, and the unemployment rate, which was expected to come in at 4.1%, actually came in at 4.3%. And so the market's gone from getting excited about a Fed rate cut to now talk that Jay Powell may have missed the mark. He should have cut yesterday. Just like the intro to the start of this video of Jim Cramer having a public meltdown back in 2007, accusing the Fed of the same thing, saying they should have acted to try and get in front of the weakening economy. Turned out he was right. So we've got a lot of people saying the Fed should have cut yesterday, and now they might have to do an emergency cut, or they're definitely going to do a 50 basis point cut in September, which Fed Fund futures are giving real possibility to now as well. So it's a bit interesting to think that this report caught Jay Powell and his team of PhD economists and all the data and insight they have off guard. However, I'll get into that a bit later on in this video, just to let you know some other things going on out there that I'll get into this video as well. We've got the pending response from Iran towards Israel, in which they've given some indications it could be unlike anything the world's seen before. So I'll get into that later as well. Some on Wall Street have also speculated that the growing popularity manufactured by the mainstream media towards Kamala Harris and her increasing odds of winning the election is causing an unwinding of the Trump trade. Small caps and Bitcoin among them. We've also seen significant strength in the yen of late. You can see it here in the chart of the dollar yen coming off hard. Potential fears of a huge unwinding of the carry trade. We also got earnings out from Amazon last night, which failed to impress the market. Large stock in the $1 trillion market cap club, finishing the day down almost 9% today, and we've still seen a bunch of weakness in the semiconductor sector as well. Intel off a whopping 26% today. So what we're going to look at today is, are we on the verge of a recession, or is this just a mid-cycle growth scare, and what does all the data point to? And what can us as active traders and investors do to respond to all this, and what could happen over the course of this weekend and going into next week? Well, to start off, the most obvious thing to do is not always the right thing to do. Chasing trades based on recent price action, oftentimes it can be profitable to do the contrarian thing. And as always, this is not financial advice. I just like to provoke thought and present a different way of looking at things, give some possible scenarios and outcomes. And so I'd say one of the biggest contrarian trades right now is taking a swing long trade on semiconductors like ARM Holding, which is currently 31% below its 50-day VWAP, technically oversold, and just reported good earnings yesterday. Because there's a look at NVDA as well, which appeared to defend its most recent earnings gap, and just going down to a 15-minute chart, that to me looks like it could potentially be signs of accumulation. Maybe some big money buying the dip here on NVIDIA in the low 100s. Just a bit over a month ago, we were looking at 140, and it appears a few investors may have started buying in the low 100s. Another most obvious trade that I'd say a lot of people are chasing today is getting long bonds, with the TLT Treasury bond up 3.12%. However, that's very technically overbought. Just looking at my DSI, it's a bit over 15, which is very stretched. Just going back in history, the last time it got above 15 was on this day here, close to a top. And going back further again, we almost got to 15 back in late December 2022. And of course, I'm not advising to short bonds here. I'm just saying those that are jumping on board now could be getting in late and chasing. And I'm going to be a little cautiously optimistic and make a little bit of an argument on today's video why I think the market may be overreacting a little bit here and now. This may just be a mid-cycle growth scare. I'm just looking at the price action of a bond ETF that's literally called Fallen Angels High Yield Bond, which even after today is still trading above its 50-day VWAP. And believe it or not, we've still got more than half of all stocks above their 50-day average. And we've got other signs of market breadth holding up. And a bit later on in this video, I'll show you some other economic data that doesn't point to an impending recession, even though for sure the risks are there. Like I've been saying for a while, we shouldn't be surprised to see some weakness in this time, a spike in volatility, especially going into the election. We did get a bit ahead of ourselves, especially in the NASDAQ growth stocks, mega cap tech. Quite often we see pullbacks and corrections after that. However, I'm seeing people all over my social media saying the Fed needs to do an emergency cut now. We're already in a recession. The bull market's over, etc., etc. There's so much fear out there. And you can see that in the options market as well. People just rushing out to buy out of the money put options, paying any price for them. We see this every single time. And I'm not saying we've definitely seen the low in this correction yet. Still could easily have a little bit more further to go, especially if what happens with Iran and Israel turns into an even larger scale event than what we saw in April. However, if not, we could have a good bounce back next week. Just looking at Microsoft here. My second consecutive reversal signal, 8.2% away from the 50-day VWAP, one of the strongest stocks in the market, could be potentially setting up for a swing trade by the dip. However, stick with me today because I'll come back to the charts. First, let's just go through all the news, data, and research out there to give you the bird's eye view. Japanese stocks just had their worst day in 4 years. Potentially a continuation from the Bank of Japan, pricing markets a little bit and lifting their interest rates. A lot of hedge funds had been long Japanese stocks and short the yen. In fact, it was a trade kicked off by Buffett a few years ago. He sold a heap of Japanese bonds and took that money and put it into the top 5 Japanese trading houses. Super cheap PE ratios, high dividend yields. In fact, the late Munger called it one of Buffett's best trades ever. So no doubt a lot of hedge funds piled it in on that as well. So there's definitely been some unwinding in the yen, taking some risk out of this markets. And all of this, weak jobs report, Amazon earnings, Kamala Harris growing in the polls, the potential of a huge response from Iran to Israel, and going into a weekend on a Friday with seasonal weakness. Like I said, there's no surprise we're seeing the volatility that we're seeing in markets right now. And it's amazing how often seasonality and patterns play out. We're almost tracking exactly the same way we were last year. Here in the green line, 2024, last year in the blue line. Markets peaked out in July, pulled back into October. Jay Powell, Janet Yellen came out and loosened conditions, pivoted their language, and got underneath markets. Which, don't be surprised if they do the same thing again, especially going into a federal election. They want the incumbent to win. You think they're going to stand by and just let markets get created going into that? If we do see further weakness and volatility, you can bet our savior, Jay Powell, will fire up the old printer and he'll do whatever's necessary to put a floor underneath it if it gets bad enough. But just keep in mind, volatility is the toll we pay to invest. I had someone ask me today, am I worried about the market? Am I worried about going into a drawdown just after launching my new stock pick service? To which I told them that would actually be a blessing. Because I'm dollar cost averaging every week, I'd much rather have a 20-30% pullback in the market in the first few years of my 10-year plan to grow a new trading account into $1 million. That would be way more beneficial than getting the account to 700, 800, 900 grand then having a 20-30% pullback, that would be a lot more psychologically hard. So I'd much rather have a 20-30% pullback while my new trading account is still small. And in fact, if you're under the age of 60, a bear market is a blessing and a great opportunity. If you're patient and have a long-term vision, that's just something very few people understand. And in fact, they quite often panic when they see a number on their screen flashing red. Warren Buffett puts it perfectly. The stock market's the only market when things go on sale, people panic just because someone else is quoting you a low price for your stock. Just like a fine bottle of wine, if you know what you got and you like it, you should be happy for it to go on sale so you can buy some more. So like I tell people, when you're investing in high-growing stocks, cyclical stocks, tech stocks, commodity stocks, small caps, these are not your grandma's bonds. They're going to move around a little. And if you can't handle a 20 or 30% pullback in the stock market, then you shouldn't be investing in stocks. You should just stick to savings account. And so we've only had a 6.5% pullback in the S&P 500. Looking back in history, most years we'll get a 10% correction, and every year and a half we'll get a 15% correction. So we very well could have a little further to run over the next month or two before finding a bottom. However, that doesn't mean other sectors can't perform well. I'm looking at areas of commodities, defensive stocks, international stocks listed in New York. I'm just being a bit cautious around the tech sector here, as that's been leading the way lower. However, for the here and now, no doubt there is fear in the markets. This could persist going into the election. US economy did only add 114,000 jobs in July versus the expected 175,000. We saw June's job gain revised down from 206 to 179,000, May's from 218 to 216, and of course the unemployment rate rose to 4.3%, 4.1 last month. We also just got the SARM recession indicator flash today, which looking back in history has been a good predictor of pending recessions. However, according to Claudia Sahm, the economist who created the SARM rule, doesn't expect a downturn right away, pointed to factors like growth and immigration and other pandemic-related factors that could be distorting it. Remember, COVID was probably the biggest economic event we saw in our lifetime. Economy being shut down, a huge amount of stimulus, really thrown out a lot of data and historical patterns out of whack, which are still normalizing to this day. And so no doubt the Fed is definitely going to cut next month, like I've been saying for a while. Real possibility they could cut 50 basis points. That would be them admitting they got it wrong. However, we just heard from the Fed 2 days ago. Did this really catch Jay Powell by surprise? Is he really behind all the traders I hear screaming over on social media that he's massively effed it up? Or does he still think the economy is holding up and inflation hasn't completely gone away? And is this the bond market just throwing a bit of a tantrum like we've seen in the past to try and force the Fed's hand and get them to act? Well, one thing's for sure, when Jay does cut next month, it won't look as political this time. Bond market's pretty much saying, hurry up and get it done. It is way in front of the Fed now. Huge gap between the 2-year and the Fed funds rate. And the market is definitely pricing in the real possibility of a recession around the corner. Which again, just to be clear, I am not ruling out either. Of course, it's a real possibility. I've been talking about this for months. However, first and foremost, as always, be following the technicals. Let the trends guide my decisions, while still remaining cautiously optimistic. Given the fact the US economy did add 114,000 jobs last month, people are so quick to forget we actually got a lower print for the month of April at 108,000, and it wasn't all that much better in March last year and December 2022. Coming into 2023, a lot of us, myself included, thought there was a real possibility we'd see a recession come mid-late last year. Did not materialize. Market continued to stay above its long-term averages. However, it can be argued that this is trending down a little bit, but just remember, going out to a 5-year chart, it may not be a downtrend when you account for the huge distortions from COVID, creating some wild swings and a lot of economic data, which could still be normalizing. And just looking at the monthly average hourly earning, which actually increased 0.23% month over month. Again, we got a lower reading back in April, and in fact, we got an even lower reading back in February and August last year. So the jobs market isn't completely dead just yet. It's actually still holding up. Of course, it's softening, but in my opinion, again, being cautiously optimistic, it may be a little too early to say the Fed needs to do an emergency meeting, needs to cut 50 basis points, sell everything, the bull market's over. You're going to see that all across your screens today because fear sells. No other way to put it. However, just getting back to the data, as we try and make data-driven decisions around here, the US economy actually grew at 2.8% in the second quarter. For those of you who don't know, a recession is defined as 2 consecutive quarters where the economy contracts. GDP comes in negative. We also saw consumer spending up 2.3% in the second quarter versus 1.5% in Q1. On top of that, just looking at corporate earning, another big key driver of the stock market. 78% of S&P companies have reported positive EPS surprises for Q2 2004. Blended earnings growth rate so far is 11.5%. That's the highest since Q4 in 2021. Earnings revisions going up. Forward 12-month PE on the S&P 500 is now around 20. Not all that bad given the current growth rate. And the forecast from Goldman Sachs is for the US economy to keep expanding throughout the year going into next year. Of course, that's not always right. However, that's what the best data out there points to. And earnings is expected to continue growing as well, especially in small caps. And just looking back at history at the trailing 12-month earnings per share growth rate for the S&P 500, currently at 7.8%. If you look back in history, most of the time we go above this red dotted line. It stays above there for a number of years. Saw that back 2017, 2010, 2003, the mid-90s and so on. And so it's not impossible for it to turn around here. However, we'd have to see a huge change in the structure of the economy, corporate earnings, for us to go into a recession in the next couple of months, like the markets are pricing and a lot of people are convinced that we are now. Just looking across Wall Street, what we're hearing out there, Ronald Temple warns of labour market weakness, hopes the Fed doesn't repeat past mistakes. Preston Caldwell says markets are overreacting, but acknowledges the bearish nature of the jobs data. BYO Wealth Management argues a 50-point rate cut is justified due to labour market softening. RSM explains the rising unemployment as normalisation post-pandemic, not a recession signal. Jefferies expects a rate cut in September and December, but sees no continuous meeting-by-meeting cuts unless a recession is evident. Mohamed Al-Aran notes the rapid shift in market sentiment, and he was saying the Fed should have cut as well. They've been a bit too data dependent instead of having some foresight. We've got Tom Lee saying you should buy the dip. Guess that's no surprise to hear from him. Contributes recent struggles to chip sector volatility. Says there's a buying opportunity in tech stocks, which, like I said, would be quite a contrarian trade here. However, let's also keep in mind Jay Powell does have a lot of ammo now. Fed funds rate 5.25%. He's got over 500 basis points of ammo to work with, not to mention quantitative easing. Tom Lee's still calling for a surge in small caps throughout the rest of the year. So there's a number of positive catalysts ahead. Economy could still hold up. Interest rates coming down, that's a good thing. And that the rotation is still intact. We still have overall long-term breadth and trends there. And again, even as sharp as some of the falls we've been seeing out there today, tech stocks, growth stocks, small caps, it wasn't a complete mass liquidation event. We still have some defensive sectors moving higher. And in fact, Apple finished the day higher after their earnings yesterday. Analysts are getting increasingly optimistic going into the iPhone 16 upgrade cycle. They're finally getting into AI. There's going to be more monetization opportunities, more products they can sell. Outside of China, they're still growing pretty good, and they gave positive guidance, expecting 5% year-over-year revenue growth for Q3. Goldman Sachs raised their target at 275, and here we are finishing the day touch higher at 219, holding on to its 50-day VWAP. Definitely looking the best out of all mega cap tech here. Just moving on to commodities. Could be an interesting weekend. However, oil's not too worried here. More concerned with the US economy. Worried demand could fall off a lot if the jobs market is going to continually and significantly weaken. And there's a look at crude. Having actually a pretty decent fall today, 3.6%, $73 a barrel, now back down to that support zone we saw from June. However, gold did find fresh all-time highs today. Definitely a little bit of flight to safety. Geopolitical risks being priced in here. We may see gold spike up on Monday if we see a huge full-scale event between Iran and Israel. And just to get you updated on that and look at what are the probabilities of that happening this weekend or over the next week or two, is definitely a real risk. We could see something bigger than what we saw in April when Iran launched 350 drones and missiles towards Israel, which were all shot down with the help of the West. Israel is on high alert, preparing for what Iran might throw at them this time, in which they're currently conducting drills around the country. They may see attacks from all fronts this time. Hezbollah, Hamas, coming out of Lebanon, Syria, and straight from Iran as well. And it's just been reported on Iranian state TV. They said in coming hours, the world will witness extraordinary scenes and very important developments. I'm not sure if they're hinting at sending mass bombs over to Israel. Some people say they've already got a nuclear bomb, but we're also hearing reports they may attack Israel on Tisha B'Av, the Jewish Day of Disasters, Western intelligence has reported. That's when Jews mourn the loss of the first and second temples, and that begins on August 12, which is Monday, the week after next. If so, maybe we don't see it this weekend. Maybe they plan something bigger to attack from all fronts, and instead of just a hours-long campaign, maybe it goes on for days or weeks. But one thing we know, the US-led Western military alliance is certainly preparing for something big here. Got the US shifting more assets into the region, deploying troops, more ships and fighter jets, B-2 bombers, all the high-end stuff. They're actually equipped with nuclear weapons as well. And just speaking strategically, if there is going to be a full-on war between Iran, Israel and the West, it'd be much more in the West's favor to deal with Iran by itself instead of a full-on global war having to deal with Iran, North Korea, China, and Russia at the same time. So like I said, this could be an opportunity for Israel and the West to cut off Iran's ability to deploy a nuclear weapon, and if they cause enough damage to Israel, Israel and the West may actually go on the offensive and just seek to destroy a lot of Iranian military assets and eliminate all of their leadership. As it's been reported that US military assets are getting into the region to assist with defensive and offensive offensive operations. And in fact, there's even been a joint resolution just presented to Congress to authorize the use of the United States Armed Forces against the Islamic Republic of Iran for threatening the national security of the United States through the development of nuclear weapons. So if Iran does cause enough damage to Israel, or maybe not, maybe even if they just do a repeat of April, 350 missiles that can all be shot down, maybe Israel doesn't want to continue to sit there and deal with that. Maybe that is a good reason to take the lead in the region, completely disarm Iran, and wipe out their leadership, which, as they've already demonstrated with the help of the West, they have that ability to do, with a high level of precision inside Iran and targets they wish to target, as Iran doesn't have an Iron Dome defense system and the capabilities and assistance of the West like Israel does. So if that does happen over the next week or two, we could see a further spike in gold. However, the flow of crude probably won't stop, so we may not see a huge disruption in the crude oil market. And if Israel and the West does respond and disarm Iran, well, in my opinion, the world's just got a lot safer. So that could be reason for markets to get excited, because it might be better to deal with Iran before they have a nuclear weapon instead of after, because they very well could use one on Israel as they would like to. Either way, I'll be keeping a close eye on it, and I'll keep you guys updated with everything I'm seeing out there. Just moving on the economic calendar, there's the prints we got today. Non-farm payrolls, unemployment rate, participation rate actually went up, and average hourly earnings just a touch lower than expected, but still growing 3.6% year over year. Looking out to next week, we're starting off with some PMIs. Not too much out on Tuesday nor Wednesday. Thursday, jobless claims, and nothing of importance out from the States on Friday, so pretty quiet on the economic calendar next week. The market will kind of be left up to its own devices to trade. I'll be looking for government bond yields to stabilize for sure. They could start off a little lower, especially if we see a big event in the Middle East. There could be a further flight to safety, so TLT could very well find 100 and above next week. However, it is technically overbought here. I'll be watching high yield bonds for signs of distress in credit markets. There's a look at Bitcoin, just holding at $61,000 a coin. I'll be watching gold, watching the spread of high beta stocks versus low volatility. We've also got discretionary versus staples coming off hard, and we've got inflation expectations absolutely nosediving as well. And I'll be watching semiconductors, NVDA, along with Microsoft and Amazon as well today, which appeared to do a bit of a buy the dip hammer candle formation. So if we don't get a mass event over the weekend in the Middle East, things should calm down next week. We may get a bit of a bounce. However, that's just in the short term. For sure, the S&P could have further to go, and we could come down and have a look at 5250. And who knows? It's even possible we come down to those lows from April, around 5,000, over the coming month or two in this seasonal weakness. And if we were to do that, it'd only be about a 12% drawdown from all-time highs. Again, within historical norms, but no doubt that is going to freak a lot of people out if they're not already. Plenty of people convinced we're already in a bear market, it's already a recession. However, I'll let the data and the trends guide me on that. But for sure, the jobs market is softening. The risks have increased, and we've just got a lot going on in the markets right now that it's trying to digest. And if things get bad enough, this guy will come in and bail us all out. That's all I've got for you guys this week. Thanks very much for sticking with Click Capital. No doubt next week's going to be really interesting as well, and I'll be back again on Monday night to break it all down for you again. Have a relaxing weekend, and I'll see you again next week. Cheers.